This series is kindly supported by GCM Grosvenor. GCM Grosvenor is a global alternative asset management firm with a long-standing commitment to supporting small, emerging and diverse investment managers. For over 30 years, the firm has developed expertise in funding and guiding these managers as part of its broader activity across alternative investments. With over $20 billion in AUM dedicated to small and emerging managers and $16 billion in AUM dedicated to diverse managers, GCM Grosvenor leverages its experienced team, broad network and proprietary sourcing capabilities to support their success. Through the Small, Emerging and Diverse Manager Programme, the firm creates opportunities for investors to access a wide range of talent while seeking to drive strong returns and impact. For more information, visit www.gcmgrosvenor.com.
You control one thing, and that is how you enter the world every day and how hard you work. You can't control most anything else. I mean, really, there are very few things you can actually control. How hard you work and how you treat people and how you approach every day are a few of them. And so those are things that, I really try to wake up every morning and take that approach.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Mike Tiedemann, who is a founding partner, CEO, and chairman of the Internal Investment Committee at Tiedemann Advisors, as well as CEO at Tiedemann Investment Group, before leading the merger that created AlTi. Early in his career, Mike lived and worked in Brazil as part of the equity research group at Banco Garantia, and later ran the equity sales and trading operations for Latin America. Mike serves on the board of multiple organizations and has been recognized multiple times for his contributions to charitable causes. He founded and chairs the River Fund, a nonprofit that provides food, education, and support services to help families in New York City break the cycle of poverty. Welcome, Mike. Thanks for joining me today.
It's a pleasure to be here. Thank you for having me.
Well, let's start with your journey into a career in investing. Can you talk about how it started, and did it take any surprising turns along the way?
Well, it started with some surprising turns. I began in the emerging markets in the mid-90s, and unknowingly I was walking into perhaps one of the most volatile periods of distress and devaluations and political change. It was really a remarkable time. It was a great training ground and crash course in mispriced growth in general, macro influences, political discount rates, currency devaluations, illiquidity, all of these dynamics that really created a remarkable background. And it was a very steep learning curve for me. And certainly as an American growing up in the US dollar as sort of the world's currency, or one of certainly the leading world currencies, it was remarkable to be sitting in a currency that was shifting percentages per day. There was inflation of about 35%. It was a really amazing time. So that was my starting point, and it was a lot of fun.
It's fascinating. I also had a sort of early point, not a starting point in emerging markets, but it really does, I think, expand your imagination as to the kind of moves as to what are possible in markets. It also forces you to improvise. How would you say that experience molded you as a professional in terms of your perspective?
Probably a little bit of humility. And I use that word because you can do all the fundamental work on a company or a marketplace, and there will be a factor that is far more powerful than that fundamental research or your understanding of an asset price or what have you. And so I think it taught me to be flexible. It taught me to be adaptable to realities and changing markets. And in general, also to be bold. I think at times there is a point where you think at a price, I'm unconcerned about the next 20, 30% of price movement. I want to own this asset. And so there are times when you really are forced to take risk and evaluate the risk knowingly that there's a lot of uncertainty.
Certainly it does force you to recalibrate, I suppose, the boundaries of risk. But even just going back before that initial surprising turn, what was your educational background? What kind of laid the groundwork for this interest in investing?
Yeah, I studied psychology, and psychology has been immensely helpful to me. And I've been working in people industry and a people business, that our clients, the people that work in our organization or any organization, that's really critically important. That's been very helpful to me. And obviously, it doesn't tie perfectly with investing, but it has certainly had practical application that has been immensely important to me for a variety of reasons.
And let's now take that forward to the psychology or the decision making of launching your own firm. What did that entail? And can you talk us through a little bit of how that progressed?
Sure. Well, I was actually, people always ask, did you know you want to start your own firm? And the answer is really no. I had a father who was a serial entrepreneur and was in his mid 70s at the time and talked to me about the concept of creating this open architecture investment firm within a trust company. And our family didn't have any trusts. So I really didn't have any experience as to what was needed or in general what the market opportunity was. But as I began to learn about it, and as I began to speak to two of our other founding partners, I came from JP Morgan, I began to see understand the opportunity that was being created by a lot of the decisions being made by large banks. And those decisions were not to the benefit of their underlying clients. And we wanted to create a sort of client-first trust company and an open architecture investment model. And so we began in late 99, 2000. We had no clients, zero revenues, and we bootstrapped our way into building a business and eventually getting our first client, who's still a client to this day, 25 years later. And it's been an amazing experience and a lot of work and at times a lot of stress. But when you surround yourself with the people that I've been lucky enough to surround myself with, all my partners, men and women all across the States and now all across the world, it's a really wonderful experience. And those cycles, the hard ones, actually teach you a lot about who you're in business with and what can really be built from there.
And just probing on that one a little, the teachings, I suppose, or the learnings that come from that. And clearly your father, having been an entrepreneur and a serial one, probably knows a thing or two about mismatched expectations, time horizons that can be perhaps longer than you originally think, the importance of networks, relationships. I'm just thinking of the usual adages that come out of serial entrepreneurs. What would you say you learned from the experience in terms of maybe setting expectations correctly, the drudgery of raising assets?
The time horizon, I think we always viewed as an advantage for us. And the reason why I say that is we had a focus on creating a permanent organization. When you have permanence as one of the governing thinking around every decision you're making and around the time frame in which you're implementing something, that permanence really gives you a duration that is different than most other people, at least as you see fit. So you're making at times more conservative decisions, or you're making investments back into the business that will pay out in 3, 4, 5 years, or perhaps even longer. But they're the right decisions, the right investments to make in the business. And it's a form of discipline that is really the inverse of what you're taught, which is, you have to have these KPIs, you need to see the results in a certain time frame. And if you don't see them, it's a failure. But when you're making what you believe to be the right long-term decision to build a business that you want to go on beyond your lifetime, then the frame in which you view those decisions, I do believe, is different and was very helpful to us over the time of building the business, certainly in the early years.
And then going from building to merging a business and having to think about all the dynamics involved in that. Any lessons learned from the subsequent merger? Any learnings from that?
Yes is the answer. With any inorganic expansion of a firm, so that can be an acquisition or merger, putting businesses together, joint ventures, et cetera, you really need to make sure you have perfect alignment. And when there isn't perfect alignment, you likely shouldn't do a deal. And so it's really important to have and to maintain that alignment as you create this sort of corporate combinations and you understand where people are going to be sitting and what roles are going to be playing. And there's a lot to think through. And you're, again, dealing with people, and you need to make sure that you create career paths, the right roles, titles, that you reward the right people and reward the right people with the right behavior. So there's a lot that goes into any kind of merger, but it really begins and I think ends with alignment, and then really a clear vision as to what can be built by doing all of that work and by taking the time to put it all together.
And getting back to your psychology, I think that alignment really gets into, well, what's in it for me or them, and as well as the incentives and motivation around that. So definitely not as simply looking at two business plans.
The first two letters of merger is me. So you absolutely need to recognize that everyone is evaluating the change and what it means for them individually, first and foremost. And if you don't respect that, then you're not really fully grasping what that change means to every single person in the organization.
And of course, making that change to have a kind of a win-win is the ultimate success, I suppose, of those mergers. And now when looking to what your focus is today, can you tell us a little bit about the firm today, now AlTi, what your focus is and how you look to the current market conditions?
Yeah, so we aspire to be and believe we already are one of the preeminent global multifamily offices that exists. And we are dealing with very, very large families that in many ways have permanent capital in their family structures. They're, in some ways, you could almost view them as taxable endowments, where they have structures that they've created for their children and grandchildren, and they've had a huge amount of success and developed large pools of wealth. And with that comes a lot of responsibility. With that comes a fair amount, if not at times a lot of complexity. And it's critically important that they are making decisions that are really great long-term decisions. And when you think about the decisions that we make collectively with our client base today or over the last 5 years, and you roll the clock forward 10, 15 years, the output of that is exaggerated in the sense of the investment decision you're making, the structuring and tax decisions you're making will have a pronounced impact on the next generations. And so there's a lot of definition around that in terms of where that capital is supposed to be invested, how it is supposed to be given to the next generations, what are the rules around that in terms of how it can be spent. Impact investing is an incredibly important entrance into how capital and really the purpose behind capital that a family has and the next generations have in terms of where they want that capital being deployed and with what end purpose. There's a lot that comes with it. That plus we have a real expertise in alternatives and strategic alternatives where we are focused on really non-correlating differentiated middle market ideas. And there are times where that creates co-investment opportunities, but ultimately we want to have a really differentiated investment platform. And that is a big part of it as well.
And I'd like to go through some of those points just one by one, because I think they really do capture where we are in terms of the evolution of the investment management industry and families and their role in them. Just maybe starting with the use of alternatives, how would you say that has evolved for you in terms of the comfort level? We're also seeing more alternative products come down the size spectrum in terms of their accessibility. Has that made a difference now that blue chip managers are readily accessible? Has there just been more coverage of, say, private credit, so it's becoming more mainstream? How have you seen that adoption, and do you see that being a more rapid rate of adoption going forward?
It's a great question. The alternative space is huge and varied. So that alternative space can be real estate, direct investing, or timber. And obviously it can be a hedge fund, it can be private equity, it can be private credit. So there's a wide range when we use that term. How I think the industry has evolved immensely in the last 20 years. And when you think about just focusing for a minute on the hedge fund industry, there was a broad expansion in the early part of this century, first 10 years. And then there was obviously the crisis in 2008. And the shift in focus of allocators went from trying to find new and emerging entrants into hedge funds and capturing capacity to only wanting to be really with the best and the survivors of the GFC. And now there's really an orientation towards multi-strategy funds. And those strategies have incredible advantages in many ways in terms of their treasury functions and how efficient their capital is and their leverage and the systems they have and the talent they're able to attract. So that segment of the industry has evolved quite a bit in the last 25 years. And then private equity and private credit. Private credit is really in response to the change in the banking system and the types of loans that banks are either unwilling to or unable to make. There's an asset liability matching that many of these funds have that is critically important and will enable them to go through a lot of cycles. But like anything, a lot of capital pouring into a single space, such as private credit, will at some point lead to credit cycle issues, or we will see a more challenging phase. We've yet to see that. I mean, people tend to forget that we've not really seen an economic pullback since COVID. So we've been in this expansive phase, and obviously the credit markets are reflective of that.
And then the point you raised before that around investing with impact and purpose. And this is maybe came as a little surprise to me that that's become such a theme in your families. How much would you say, what percentage of the families maybe is that an aspect of their investment? And then for some, is it just about the financial return? And the reason I thought it was a surprise is just looking at the US, not every geographic area has the same perhaps focus on impact in some of those purpose-driven investing.
So you're asking a few questions within this question. One is it a political issue or is it an investment opportunity? And I do think the line gets blurred there. And I think it's very important to understand that when we're discussing impact investing, which is a term that gets thrown around quite a bit, we're predominantly talking about private market activity. And that private market activity is oriented towards climate solutions, energy transition, investments into women backing women, agriculture. These are all scale and critically important investment opportunities that are underpinned typically by technology. So if you think about the fintech or ed tech or health tech, climate tech, you go down the line, that's really the big change in the last decade is that now technology underpins many of these investments. So there is a scale potential. They're not all going to be winners, but there's a scale potential and a sustainability component here that is very different than it was 10 and 15 years ago. So the conversation is less sensitive, at least the way we engage with families. I don't know many people who don't care about the climate. So when you think about whether you're a Republican or a Democrat, irrespective of your political views, typically you would like to be a part of a solution or investing in a solution. We do it in two ways. One we call non-concessionary. So we want to make sure that our clients are, if they're investing, that capital is coming back to them successfully, and then they can redeploy it again. This is not charitable investing. And then there are people who are willing to have sort of concessionary, under market returns to deploy capital with a specific purpose. But it enables the families to engage in a dialogue about their money very differently than just spending, making and spending. It really begins to define the values of a family and what it is that you as a family want to invest in and how you want that capital invested and deployed.
I love that, defining the values of a family and letting you express that through investing and different types of investments. It really, I think, captures the power of the individual to make their mark. Just staying on that topic a little bit longer, a lot of the topics that we discuss on this podcast are around the investment industry's own evolution, becoming more diverse and responsive to the reality that the clients they serve are diverse. Any thoughts on that in terms of the composition of the industry itself?
It still has a long way to go. I think the fact that there's intentionality around diversity and the opportunities are now beginning earlier. And I think this is one of the things when we think about intern programs, just as an example, the intern program that we are doing and have been doing since sort of 2017 or so have been much more oriented around really opening up a much wider spigot and having a much broader set of candidates. And invariably, they've been far more diverse than they were previously. And I think that is fabulous for a couple of reasons. One is you're getting an incredible talent pool. And so from our standpoint, you're getting an incredible talent pool and exposure to people and kids that you just weren't earlier. And then two, these kids now go on with a resume that it begins to be built earlier in, while they're going through the university or they're completing the university. And it gives them just a notch up and a better opportunity than they were getting 10, 15 years ago. And so I think the more that continues to happen and the more that firms realize that it has layers of benefits, I'm hoping that the industry will continue to be more and more diverse than it has been.
I'm just moving on to some reflections now. So you spoke about a career being born amid some volatility and a little bit of adversity, given the South American and the emerging market backdrop. When you look back at your career, were there any setbacks or challenges in there that you learned lessons from?
Sure. I'll tell the story without giving too much detail, but essentially we had one of the very rare times in our 25-year history where we invested in a manager that used a lot of leverage, and that leverage ended up taking the fund out of business. And it was a very painful experience. It was one that we should have known better. We undoubtedly made a mistake, and that the mistake was really understanding and respecting the fact that the amount of leverage needed to drive an investment return or the amount of leverage used is really inversely correlated with that manager's shelf life. And what came out of that was it was a signal that the GFC was coming. And as a result, our response to that mistake was actually exceptional. We ended up reducing and removing a lot of exposure within alternatives and just in general portfolio risk that enabled us to go into the Lehman crisis, the October of 2008, with a huge amount of cash in our client portfolios, and we were significantly more conservatively positioned, which enabled us to reinvest, as we went into 2009. And that was a big turning point for the firm. Now, but it started with an embarrassing pain point where we lost some client capital and, really had to answer to that.
If only all losses could pay off so well in terms of positioning later. I do think that leverage and excess leverage is one of those indelible mistakes that anyone who's experienced it will never make again. And it's not every investment mistake is like that, but I think it is just the severity and the suddenness of a turn that leverage can amplify.
The liquidity is another version of that as well.
Yes, true, actually true. So absolute no-go areas that unfortunately those of us with the institutional memory of that may be fewer and further between at the moment, but important lessons. Looking at key people, and we started this by talking about the influence of having had a serial entrepreneur in the family. Any key people you can mention who were particularly influential throughout your career, bearing in mind it's not an exhaustive list here?
Yeah, absolutely. I would say my father being one. My father, of the things that he did every single day, he came in to the office, and the larger the gap in stature was between he and the person he was talking to, the warmer he was. And he did that with unbelievable consistency through challenging market cycles. And what that ended up creating was a work environment where people respected each other and were nice to each other. And he was the example at the top of someone who treated everyone with respect. And so there was really no room for anyone to act and behave differently. And so great examples of father, very lucky to have him. Roger Wright was my first boss and in many ways a father figure when I lived in Brazil in my early 20s. He died tragically in a plane accident. But while he was my boss, he was a leader and someone who just brought this incredible energy, loved putting people out in front. He loved to promote his team. It didn't matter how old you were. He wanted to see you succeed. He pushed you. He put the spotlight on you. And really, that to me was something that I watched as a leader rather than taking the spotlight, was really someone who wanted to share it and really wanted to put people out of their comfort zone and see what they could do and really almost teach them or have themselves learn what they're capable. And the last person is Henry Kravis, who obviously has had from KKR, has had incredible success. I would say that the one key takeaway from Henry was how prepared he is for every single meeting. Anytime that I've come to sit and visit with him, he knows everything about me and everything that I've done. And it's just always remarkable that someone of his stature would take the time to be prepared for each and every meeting that he has. And so preparation in general, I think, is one of the key defining differences in success. And he was a great example of that for me.
Really interesting. Some wisdom in there and all of those recollections. And that's another question, but we'll get to that one. Before we get to that one, though, we mentioned the River Fund in the bio introduction, and obviously a cause that's very close to your heart. Can you tell us a little bit about that and about some of the other charitable causes you work on?
Yes. I found the River Fund because my mother, who's amazing, sadly, she passed away in 2012, but I was going through a challenging period and she sat and listened to me and said, "Oh, Michael, I'm so sorry. It must be hard. But what you really need to do is a little volunteering because your worst days are other people's dreams. And you need to get a little perspective and just remind yourself how lucky you are." So that's what led me to volunteer there. And at that time, it was an unpaid group of volunteers. There was no board. So we founded the board. We began really creating the institution around volunteerism, all poverty oriented, serving food, helping with benefits. And then when my mother passed, we started something called a gap funding scholarship program. And so the Mary C. Tiedemann Scholarship Program has now had over 90 children who are incredible, coming through very hard lives and able to get a college education. Now, what you don't know is of the population that gets full academic scholarship coming, that grew up below the poverty line, about 85% of those don't go to college because they don't have book money, bus money, food money. They have to drop a job because they're helping their parents with rent. And so the best and brightest of this community are being really having this opportunity removed from them over $7,000-$10,000 a year. And so we created this foundation, and the kids, the stories are incredible to see what's going on. So it's really been one of the best things that's happened in my life. And it really is something that has changed my perspective and my kids' perspective, because we all go out and volunteer, and it's a wonderful place. So thank you for asking.
Very inspiring. And then the last question is back to that wisdom. Any creed or motto that you live by now, or maybe advice for your younger self that you can leave us with?
Read more, listen more, ask more questions would definitely be something I would say. And just you control one thing, and that is how you enter the world every day and how hard you work. You can't control most anything else. I mean, really, like, there are very few things you can actually control. How hard you work and how you treat people and how you approach every day are a few of them. And so those are things that, I really try to wake up every morning and take that approach.
Well, I love that, because it's kind of brought us full circle to where we began, which is with the emerging markets that none of us can control, and that really present markets perhaps at their most brutal at times, as well as exhilarating. And I think what I've taken away from this podcast is really the center around people. From the second father you mentioned in that emerging market, hostile market environment, to the people that you've worked with, to the people that you work with today to help them implement their purpose through their family investments, to the people that are less advantaged that you help get on the road and stay on that right track. So there's been a lot of people and relationships woven through this, and I want to thank you for tying that together so beautifully and for sharing your insights with us.
Well, thank you so much. It was a pleasure to be here.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.